All right, I'm going to go ahead and call our meeting to order. I'm going to start with roll call. John Vischer, member.
Matt Marker, member.
Art Keto, member.
Harvey Lewis, member.
William Johnston, staff.
Gregory Williams, staff.
Brendan Vavrica, Anco Consulting.
William, do we need to notify our guests here, staff?
No,
Okay.
he's not participating in the meeting.
Okay, I didn't think, I just wasn't sure. Okay, very good. All right, we have an agenda before you. I'd be very happy to accept the motion and a second to approve and accept.
So moved. Second.
Good, very good. All in favor, please say aye.
Aye.
Okay, we had the minutes sent to us from our last meeting. Are there any adjustments, amendments, suggestions from any board members? If not, be happy to.
I just had one question. I know we had someone scheduled to speak last meeting in the show. I was wondering if we ever had a resolution to what happened there. I don't know if that's a minutes related thing, but
Yes.
or 2 meetings ago.
Will you want to speak to that?
I'm sorry, I was dealing with this. Could you repeat your
We're
question?
talking about Carol Hanley. We had, we basically, our speaker was very, very ill.
Okay.
And
He spoke at
Maybe he came back the next time.
The following meeting, yeah, you were, I think you were
I
on.
missed.
Yes, miss, he
Got
was
it.
there, so we're good. So good, I appreciate that, bring that to us. Any other, if there's no other adjustments or questions, I'd be happy to entertain a motion and a second to adopt the last meeting minutes. Do I have a motion?
Move.
Okay, second. Second. All right, all in favor, please say aye.
Aye.
Great. All right, I guess we're gonna go with Twin Capital or Brown Advisory is first. So let's go ahead and start with Brown Advisory. Gentlemen, you have the floor, or the screen as it may be.
So, hello everyone, Kevin Lawson here. I'm looking for my colleague Chris Gibson, who I don't see on the attendee list yet, so maybe he's having some difficulty logging in. But go ahead and get started, and we'll see if he catches up. Would that be okay?
Yeah, I thought I just admitted Chris, but I don't see him, so I'm not sure. Maybe he has to log back in or something.
Okay, maybe give him just a second or two to see if he can log in. Wish we could all be there in person. Unfortunately, we're sort of still in this kind of in-between mode in terms of travel and trying to sort of keep everything safe. So looks like here comes Chris. So unfortunately, hopefully next time we'll be able to be there in person.
Great.
Hey, good morning, everybody. It's Chris Gibson here from Brown Advisory.
Good morning, Chris.
So I just had a little bit of a Zoom issue, but happy to be with you all.
Well, it's good to see you. We've all experienced those challenges with Zoom, so I'm glad you finally made it aboard here. So.
Thank you so much.
Yeah. So you guys are first up on our agenda. Please feel free to proceed.
Can everybody see? Everybody has the materials in front of them and everything? Are we all set from that standpoint, or do we need to share the screen or anything?
So I am sharing your presentation, Chris, but if you prefer to share it yourself, you can, if that's easier for you.
Let me try to do that. I think you can drop in just to make it seamless, just because I've had a little bit of an issue on my end, so I hate for things to be disrupted just in case it pops up again.
All right.
Okay, so we'll go ahead and get started. And I think, from the vantage point of how we want to structure today's discussion for the benefit of the committee, we thought we'd just kind of do a deeper dive into year-to-date performance and also spend some time on some things that have kind of transpired from a benchmark perspective and valuation perspective over the past couple of years or so, just to make everybody aware of what's kind of happened big picture-wise, but also talk about our portfolio and how it's kind of made its way through some of the bigger benchmark changes in terms of constitution and also some valuation. I'll just kind of start if you just were to go to, I think it's page, just from a quick firm update perspective, I'll just talk about the assets. At the end of the second quarter, June 30, 2021, assets were roughly $128 billion at Brown Advisory. Obviously, that's split between both institutional and private client. In your particular relationship, you've been a long-term client of the strategy, and we definitely appreciate that. This table just basically highlights all the activity in the account since inception. We definitely appreciate the additional allocation that we received from you all based on the pension bonds. And, you know, as of 7/31, your account is at roughly $70.6 million. Again, there's nothing really that's happened, you know, to note at the firm other than we continue.
Recording in progress.
We continue to grow, we continue to expand, you know, our business lines and our product offerings. But with that, I'll pause from a firm standpoint. If you really want to spend a lot of time on the portfolio, on performance, valuation, and the benchmark versus I'm talking about the firm. If there are any questions, I'm happy to answer those right now.
No, you go ahead and proceed. Thank you.
Okay. All right. With that, I'll turn it over to Kevin just to kind of kick off talking about the strategy and performance.
Sure, so why don't we roll towards slide number 11, and that is a snapshot of the performance, and we can touch on that. I think, well, maybe just to step back and just remind everyone in terms of how we do what we do. We're a large cap growth manager. We want a concentrated portfolio of what we believe are companies with best-in-breed business models, ones that we think can grow their earnings at a rate of at least 14% or better over a full market cycle, and that's roughly twice the long-term average of the broad market as defined by the S&P 500, but also a premium to the Russell 1000 Growth Index, our style benchmark. And so we're looking for the fastest growers and the best-in-breed business models, and then we also care about valuation. We have a steep discipline in terms of valuation and what we're willing to pay for business models. And so with that, let's take a look at just the recent performance. Year to date, things have gotten a bit better from last year. Last year, obviously, was a very interesting year in terms of the COVID backdrop, which we continue to obviously be living through today. But we're starting to see some bifurcation there in terms of those COVID winners and the ones that, you know, have this huge tailwind behind them. Some of them continue. The legs are continuing to be there and they continue to push. You know, things like digital advertising and the whole notion of digital transformation is still very much in play. However, we're seeing, you know, a bit of a breakaway in terms of the stocks that, you know, maybe are running up against, you know, tough comps or having supply chain issues. Or so it's just not this monolithic trade of these mega cap companies that are dominating the market. And we'll talk a little bit more about that a little bit later, but we're starting to see that, you know, phase, you know, move out of that phase of the market and the portfolio. Obviously, as we see, you know, really strong fundamentals continue, we're starting to see the portfolio outperform the benchmark. And you can see here on the 3 and 5 years, we're right in line with the benchmark. And we're also, you know, sort of, you know, we never like to sort of perform in line. We're always looking to outperform. But if we think about it, put this, you know, these numbers in historical context, keeping up with the benchmark in a market that's compounded at, you know, over 23% for 5 years, which is probably meets anybody's definition for a momentum, you know, bull market. Keeping up with that is for us, you know, seems like almost a win, just given how difficult it's been in terms of how narrow the market it has been, and we'll talk again about that a little more in terms of the you know, the dominance of these sort of mega cap companies, technology and consumer companies. But suffice to say, on a historical basis, you know, being in line with the benchmark is very much similar to how the strategy has performed in this type of market environment. And when we tend to see the volatility pick back up, and, you know, back in March when the market, you know, is down very sharply, I know we talked about this before, but we protected capital. And so when we see that transition, those transitionary periods when things get volatile and things get more sort of maybe more normalized, that's when we tended to provide a little bit of distance relative to the benchmark. And so again, if you were to sort of, you know, write a script for how the strategy has performed over the last several years, especially during this COVID environment, it's very much in terms of the expectations that we would have had going into it. So let's just take a quick look at the next slide, which is the attribution. I won't spend a lot of time on this. I want to spend a little bit more time on some of the individual stocks and contributors, and then some of the, you know, things that we're seeing in the marketplace, and to answer maybe some of the questions that you guys may have. But just, you know, just taking a quick look at this, a lot of numbers on this page. About 2/3 of the way down, you see the information technology line, and then all the way over the right column, you see there's 130 basis points of relative outperformance. That's good to see, as technology had been a big drag throughout the COVID, you know, environment. We're underweight, you know, technology in this portfolio, given the fact that momentum's been behind it, and you just have these mega cap. Recall that we're only going to hold 5% of a business model, even though we love Microsoft. It's a great business, wonderful business, and they're doing phenomenally well. However, we're not going to hold more than 5%. We're not going to abandon disciplines that we've had in this portfolio in terms of risk controls just to load up on an individual stock. We just don't think that makes a lot of sense in terms of allocating capital, and so we're not going to change our stripes there. But that gives us, from time to time, an underweight. That's actually starting to, again, help this year to date, as some of those stocks have not kept up with the market. And then on the negative side, you can see communication services. That's really, where you have a lot of those digital advertising companies. I mentioned that before. Digital advertising has been a trend that just continued through COVID and continues upward. And so Facebook is a company we don't own. That's done very well. We do own a number of companies, and we've added to some companies, or added a company into the portfolio that is going to hopefully capitalize on the trends in digital advertising going forward, and I'll talk a little bit about that more. But those are the highlights in terms of sectoral, the sectoral activity and just performance attribution. Let's go to the next page, and we have some of the stocks. Let's stop right there. And so let me take just a quick pause and see if there's any questions on what I've already talked about before I jump into this and then the next couple slides. No, good. Okay, so just to quickly touch on some of the contributors that have helped on a year-to-date basis. As I mentioned, before, a number of these COVID beneficiaries like a Google and a Microsoft, continue to do really well. Digital advertising is a space that just is continuing to garner more and more share from advertising budgets as even we move beyond the COVID world where everybody was online. We're still continuing to see a big transition there, and that's helping obviously that whole space. Google, and Microsoft continues to benefit from things like what we're doing today in terms of virtual meetings and just virtual teams and being able to collaborate and get your work done at the end of the day. Their tools are very helpful in that respect, and they're really firing on all cylinders. Intuit's a little bit more surprising in terms of, you think about the tax software, which is one of their obviously large businesses, but they also do a lot in small business. And I think the expectations for small businesses were pretty dire, over the last year and a half, given the COVID environment and a lot of small businesses not doing well. Their small business division is actually doing quite well, and so I think that surprised the market. And so the stock has done much better, and the business is doing much better. As again, they're firing on all cylinders, given the taxes has always been quite strong, and the new, some of the new innovations they've done there have really taken off. But also the small business segments are doing quite well, which is a nice surprise. And Dexcom, I might have talked about this last time. It's the continuous glucose monitoring stock. Continues to do very well. They're getting close to releasing a new, much smaller device, hopefully towards the end of this year, early next year, and they just continue to innovate. And obviously, as diabetes being a big comorbidity with COVID, it's been very important for doctors and patients to get on their diabetics, to get on these continuous glucose monitors, because it makes them healthier. And so we continue to see that stock rewarded. And that was it had a bit of a snapback. I think, the stock, really didn't do all that well up until sort of mid-second quarter. And so we're happy to see things, it was just sort of being ignored as other things were taking center stage, especially with the reopening type stocks. And so I'm happy to see that stock recover. NXPI, last one I'll talk about here on the positive side is a semiconductor company, obviously, and They are, they're in a challenging space right now, obviously with the supply chain issues. However, that's helping pricing, and so they're able to manufacture and get some of their in-house manufacturing. They also do a lot of contract manufacturing, so they are behold that. We talk a lot with them about their supply chain issues, but suffice to say they're in one of the sweet spots for semiconductors. Is one of their big end markets is automotive, and so there's obviously, as you probably have all read about, difficulties getting chips for. It's not, a lot of it's not the NXPI chips. It's some of the more commoditized chips. They do very specialized chips. Think about the key fob, where you just walk up to your car and that that unlocks the car, or some of the networking equipment, and then they also do battery management for electrical vehicles, and so they're very diversified, very strong in a lot of sweet growth very strong growth areas of the automotive segment and then other segments as well. So we can, we like where they're positioned. Let's talk a little bit about the bottom five. All of these, except for one of these, are either new additions or eliminations from the portfolio. So they haven't been in the portfolio. The only one that is been in the entire period is Brown-Forman. And so Brown-Forman, obviously, the spirits company. It's obviously been, give and take in terms of the COVID, where you had on-premise slow down dramatically, but then at home consumption pick up, and the stock did reasonably well throughout the COVID environment. However, there are some tariff issues that are going on and a sort of back and forth. We think the Biden administration, at least the evidence so far shows they're going to be a little bit more reasonable in terms of negotiating with Europe in terms of the however they haven't tackled the whiskey tariffs, which are a significant issue for Brown-Forman, and that's been a little bit of an overhang on the stock. And so we're happy that the fundamentals have been a little bit stronger than we expected, but the margins have been not as good as we expected, and a big part of that is just due to those tariffs in Europe. And so we're watching that one closely. Pinterest, I mentioned, is a new holding in the portfolio. Again, it's a company that we hope is going to capitalize on these trends in digital advertising. They're in the very early stages, so think about a company like Facebook maybe 5-10 years ago. That's what we think Pinterest is. It's very early days in terms of monetizing their platform. And their user growth. The stock has been volatile recently, given the fact that the market is so focused on users versus monetization. The monetization path has been fairly stable in terms of, and exactly the way the management team has been talking about it. However, the market seems to be more focused just on pure user growth. And I think if we were to look back at Facebook in terms of the early days of that business, their user growth wasn't a straight line up. It probably went up and down, and so we think the market is focused on something that maybe on a long-term basis not really as relevant, but it does affect the stock on a short-term basis, i.e., giving us a chance to build a position in the stock. And then the last round are Fortive, Genpact, and Alibaba are all stocks that we had sold throughout the period. You can see they're not really down all that much, but they were eliminated from the portfolio. Fortive was an industrial company. We swapped out of it for a different industrial, which we think is a better opportunity, a company called IDEX. Genpact is a software company that really just the growth rate has slowed, and if we don't believe a company can support that 14% growth rate, as much as we may like the stock and like the company, if it doesn't meet that basic criteria for us, we're going to move on, and that's what we did with Genpact. And then Alibaba, obviously there's been a lot of headlines about Chinese companies and the regulatory environment in China. There was always a risk for us. However, it looked like this risk isn't going away anytime soon, and it's always going to be an overhang on the stock, at least for this foreseeable future. And so, there's better ideas out there. There's better opportunity to allocate that capital, given the fact that it looks like Alibaba is just going to be beholden to, these issues with Chinese technology and Chinese regulation for the foreseeable future. So we moved on from that stock as well. So let me step back from that and let's just see if there's any questions on the stocks, and then I'd like to talk a little bit more about the current environment and what we're seeing and what what's going on with the sort of broader market.
Kevin, this is John Vischer. Could you just briefly speak on the Alphabet Class C? Could you explain why you selected that share class versus the others?
Yeah, sure. That's a great question. So we owned both classes of the stock. Actually, we owned it when it was just one class, right. And then they brought out then they broke it up and made two. Well, actually, there's 3 share classes, and the other one is just held by the founders. But there's 2 publicly traded ones. So the C class is we had a little bit more in that particular class, just when the way that the percentages broke out. And when we were trimming it back, we ended up eliminating the other class. We are indifferent to which class that we own, and I know there's some debate as to whether, and when they initially did this way back when, I think it was 4 or 5 years ago, there was a class action lawsuit, and the company actually had to guarantee that the performance is going to, they'll have to reimburse owners in C class if it underperforms dramatically the other class. And so from time to time, they do sort of, go a little bit, just because the company has been buying back the other class, which arguably could, because they're, trying to, and the ultimate goal is to try to diminish that class and use the C class as the primary trading vehicle. However, it hasn't, they've been sort of both, kind of the same weight in terms of it. So we again, at the end of the day, are indifferent to which class we own. It just worked out that way that when we trimmed it a few years back, that we ended up eliminating the other class, and so we just have the C class.
Great, thank you.
You're good, John? I got a question. Years ago, you used to hear an awful lot about political risk, and it seems to have dissipated in recent years. But you just brought it up with respect to BABA. I mean, do you have those same feelings as to Chinese stocks generally, or Chinese businesses in terms of the regulatory risk in China?
It's a great question. I mean, we don't have any, Chinese analysts here. That's part of the issue, is that we don't have a good view in terms of what's going on in the Chinese regulatory. We do have a couple of folks on our team that are, Chinese, one fellow who's a Chinese national, and so, he's familiar with it, and he actually now covers Alibaba because he's a little bit closer, to obviously what's going on there. But it's really hard for us to handicap that. We don't have, it's not our skill set to sort of, analyze, Chinese geopolitics, and so, I think, it's a great business. I mean, there's some really great businesses in China, and there's no doubt about that. And I guess if you were to ask me, I don't think the Chinese government has an interest in really hampering the growth of their economy and the growth of their businesses, but they're going to do it in their own way, and that's fairly unpredictable. And so I wouldn't say that I would be averse to owning Chinese businesses if they were just businesses in China and they have the same rule book that we have here in the U.S. and the same sort of level of transparency, but they don't. And so that just makes it, a much, tougher thing to analyze, in my opinion. And so, that's really where we're at with these business models.
Yeah, I mean, wouldn't it be better to get China exposure through American companies that trade or sell extensively in China? I mean, the risks of, everybody's asking now, where's Jack Ma? I mean, it's just, why take that risk when you can get the exposure through American companies that sell extensively in China, like McDonald's?
Yeah, no, you're exactly right. We do have many of those, and I use a great example is Estee Lauder. Their skincare products are doing phenomenally well in China. In fact, that's really supplied a lot of the growth that we've seen recently, especially in the last couple quarters, but over the last 5 years, their skincare products have done really, really well in China. And obviously skincare in China is a much different, category, as, Chinese women aren't, they view that as something that they're not going to switch. They found a brand, and skincare is a very important product for them, and so it's it definitely goes. I totally agree with you. Yes, and that's what we sort of try to find, is these companies that are capitalizing on the growth of the middle class and the growth of the consumer in China, but not have to take that sort of regulatory, exposure risk.
Great, any more questions from the committee?
So let's just quickly then move on to, I think we have a couple of extra slides here. I think I talked about most of these. I think just Chewy is obviously a company that people may know. And now Yellow Pet, you probably know, and they're obviously capitalizing. It's we love the pet space. The companion animal arena is a very attractive segment of the market where you have people that just, they're always willing to spend money on their dogs and their cats and their pets. And so the stock, took a pretty big correction as it got a little bit ahead of itself throughout the COVID environment, gave us a chance to build a position in it earlier this year. And then Viva, I'll mention, is just a software company that is primarily in the healthcare market. So it's think of a Salesforce.com, but primarily in healthcare and biotechnology. And so they're sort of capitalizing on the growth in that segment of the market. And it's a vertical software company, so they do a couple of things like managing those huge relationships with clinical trials, but also they have like secure document type software as well. So that's what when we sold Alibaba, we had been following Viva for quite a long time and wanted to build a position there. So I think I talked about the rest of these. So why don't we move on to the additional slides here. So this is one that I just wanted to point out as something that is fairly unique. I think it's sort of in terms of on a historical basis, this has never happened before, where you have the top 5, the orange bars of the Russell 1000 Growth Index, our benchmark, and then the blue bars are our portfolio, which is fairly consistent in terms of the top 5. Call it between 20 and 26%. Bracketed for the last 5-10 years, actually as far back as you can get. It's been fairly consistent in terms of that exposure to the best companies that we think, the best opportunities that we think are out there. Contrast that with the market, which has gone, was at 2016 at 17 before, which actually is arguably still, again, in my opinion, for an index that has 400 or 500 stocks in it, a pretty high concentration, but now it's up to 30, got up to almost 35%, it's 34% roughly now. When you're looking at an index, you're not getting a diversified portfolio anymore. If you go passive with this index, you are getting a concentrated portfolio of high momentum, mega cap, sort of COVID technology winners, and consumer stocks. Think of Amazon, Microsoft. Again, I'm not opining on whether these companies are good or bad. You're just getting an overexposure to those businesses, which have done well, and we saw that in terms of the way the benchmark has been working. But this has never happened historically. Even if you go back to the late 90s, the concentration wasn't this high in the top 10. It was pretty close, but it wasn't as high as it is now. And so it's a very unique period of time. In fact, if you roll back to the clock, again, this has just never been something that we've seen before in terms of the concentrated nature of the portfolio. And if you look back historically, it's not, the top 10 stocks in the benchmark are rarely the same 10 stocks 10 years from now. And so again, I'm not opining on whether Apple or Google or Microsoft are going to be around 10 years from now, but if history's any guide, they're not going to be in the top 10. So just the nature of growth and the nature of innovation, tends to change, market, and the pace has only gotten faster and quicker in terms of that happening. So let's take a look at the next slide.
I just wanted to add one thing on this particular chart too. I can just go into the term of the concentration and weighting. The other thing to think about too is that most of these stocks within that top 5 to top 10%, they're priced for perfection. So any misstep leads to a dramatic either sell-off or correction in those names for a short period of time. So you're taking unnecessary risk from a valuation perspective, and also just how the market kind of views these particular names, given the run that they've had, how they've performed over COVID. So any misstep in terms of any metric from an earnings, revenue, sales growth, user growth perspective, you tend to see these stocks get hit pretty hard. And while Pinterest doesn't have a high weight in the portfolio, that's a dramatic example of what can actually happen when they miss a particular metric from one quarter to the next. So just wanted to highlight that point as well.
Yeah, that's a great point, Chris. I think Apple's a great example where they've had one of the best quarters in the history of the company, yet the stock is underperforming on a year-to-date basis. So, when you start to see a company that, is producing excellent fundamental numbers, but the stock, kind of goes down on that news, things might be sort of peaking in terms of what's going on. And so, that's an interesting period of time. It's a very interesting point. So we just wanted to show, I think we've seen these charts before, I've probably shown this to you folks before, but this just really quickly, these blue and green dots are the performance of the strategy, the endpoint of a rolling period. On the right side, you have 1 year, and on the left side, 5-year periods. And so the blue dots are periods of underperformance, the green dots are periods of outperformance. Obviously, on a percentage basis, we outperform more than we underperform, but it's not, 100% of the time, and there's more, 61% of the time on a 1-year basis. But if we focus on the one on the right side, that little red dot, that essentially ends in March, but that was the end period in March of this year. It was the second highest returning period for the Russell 1000 Growth Index in its history. You have to go back to the 80s, I think 1983 to be exact, in terms of a period that was higher on a 1-year basis than the period ending. And so you can see there's many periods in that time period where we underperformed and not kept up with the market, especially when the market gets frothy and as narrow as it has been, as I mentioned, but pretty close and not dramatically different from other periods. And so this isn't a period of time that's dramatically different. There's a lot of things that are unique about it, but again, from a performance perspective, very much in line with the historical pattern And then if we look at the 5-year on the left side, you can see the dot is right in line with that diagonal line going through the middle there, which means we're right in line with the benchmark, as I mentioned that before. And so we're pleased, given the high absolute return. You can see that red dot is pretty close to those points on the upper right side of there's only a couple of dots that are past that. And so again, when markets get that high, if you were to say, I think we bracketed between, call it, 12 and 20%, that cluster of blue dots there, those are the times on a 5-year basis we've underperformed. Very high absolute return markets. If the market compounds at 15 to 20% for 5 years, that's a pretty robust bull market, a strong market. Historically, that isn't the case. And if you look at, I think it's something like 66% of the time, the market returns 12% or less, meaning the Russell 1000 Growth Index, and we've outperformed in every single one of those periods. If you were to draw a vertical line there, I think it's around 12%. And so again, we're never happy when we just keep up with the market, but under the circumstances in terms of what's going on is very much understandable given the historical context of this strategy and the historical patterns that we produced. And then I think we have a couple of other slides just to talk about valuation, and then take any more questions. So we just wanted to kind of give you a historical look at sort of the PE valuation. These are 4 PE ratios based on estimates, and you can see, it's increased a little bit over the last, call it 3 years, in terms of our spread. So the blue line is the portfolio, the orange line is the benchmark. And so, that we haven't changed what we do in terms of valuations. Obviously, really faster growing companies, especially, software companies have grown. We're actually a little bit underweight that segment of the market, but suffice to say, you've seen that. One thing I just want to point out here is, one, it's well within the historical ranges if we look back in terms of a longer term view of this. So we're not, at a point where the PE ratio is, or the average for the portfolio is significantly. The other thing I'd also point out is that this isn't a very good indicator. There's a pretty low correlation with the performance, the relative performance of the strategy and the PE ratio premium too. We always have a premium given the premium growth rates that we look for. We're always going to have a premium growth rate. But if you look at sort of December, where 13, like at 2013 on here. That was, the spread was pretty tight. It was pretty, on a historical basis, probably, at least from this graph, fairly tight. But then 2014 was a really good year in terms of relative performance. But then if we look at, sort of December, 2016, which was a tough year for us, it started to widen out. 17 and 18 were really good years on a relative basis. And so it's not really indicative of, it's not really a good metric in terms of predicting performance of the strategy, relative performance for that matter. And one of the things, that causes that is just the fact that PE ratio isn't a great metric for a lot of companies, especially some of the software business models. If we use an example of, Salesforce.com, a company we've known for almost a decade, if you were to trade that stock based on its PE ratio, you would be making the wrong decisions at the wrong time. So, there's, you have to be, we have to use a matrix approach in terms of valuation. Obviously, we're not going to buy stocks that we don't think we can make money in, where all of the upside has been amortized away, and we're going to be patient. We're sticking to our knittings, but PE isn't always the best metric for these growth companies that are a more nascent period in their growth rate. There's other metrics that are helpful in guiding us in terms of allocating to those types of business models that have such huge and growing markets and the ability to attack those. And so we feel really good about where the portfolio is positioned in terms of business models. We're again not always using PE as a guide in terms of valuation, so it's going to vacillate. And also the last point I'll make here is that PE is in earnings right now. Given the COVID backdrop, these are our sell-side analysts, and they're all over the map in terms of, companies have taken guidance, and then eliminated guidance. Now they're adding it back, and so you have a lot of comps that are a little bit weird just given the COVID environment. So we have to take a little bit of those numbers with a grain of salt in terms of PE. Again, we're looking for long-term, kind of growth of a business model and what it can produce versus just, 1 year PE, or these are that's sort of 2 years out. But again, at the end of the day, they're just the analyst's best guess at what they could be for the next year or two, not what we think they can do 3 to 5 years from now.
And just to reiterate that point, that's the sales side analyst's best guess. Our analysts obviously have our own, fundamental view, our own proprietary view that's not reflected in this. This is more of the sales side number, consensus numbers that's reflected in this chart in terms of public information.
So I think we have maybe one more slide. This is just the same sort of analysis, just looking at price range to growth. That's the other thing I'll mention here. It's a very similar sort of pattern in terms of what we've seen sort of relative to the benchmark. The one thing again I'll just point out is that this uses a long-term growth ratio, and most sell-side analysts, a lot of sell-side analysts don't even produce the long-term growth because their clients don't really care about it. Their clients are typically hedge funds, high-velocity traders that are looking for the next couple quarters to 1 year out at the most, and so they just don't spend a lot of time on it. That's where we spend all of our time in trying to understand what the competitive dynamics are and what a business model is going to be able to produce 3 to 5 years from now, not the next couple quarters. We really don't care actually in terms of what we care, but it's not really relevant in terms of our investment thesis and what's happening in the next couple of quarters. We don't talk to management teams. Can you tell us what's going to happen next quarter? Can you confirm our channel checks? No, we're asking, how are we going to allocate capital over the next 3 years and go after this, incredible market opportunity? So I think we have just one more slide on this. That was it.
That's the last one, yeah.
So why don't we open it up for questions and see if there's any questions on those charts? We have the portfolio. Happy to answer any questions on the portfolio or anything else that we talked about.
Any members? No? Brendan, any questions?
Not for me.
Okay. I think you guys covered everything that we needed to hear, so I appreciate your presentation today. Any closing comments you'd like to make?
Hey, look, we definitely appreciate the time. We definitely feel like the portfolio is well positioned to take advantage of what's going to happen on a go-forward basis. We're comfortable where we are from a valuation perspective. Kevin obviously did a deep dive in terms of talking about everything that's happened, over the past year-to-date performance and some of the other things, dynamics affecting the portfolio and how we've kind of done in momentum markets. But I think we like to say that, we definitely feel good about things. We think that we're well positioned. And Kevin, I'll turn it over to you to see if you have anything else you want to ask that.
Yeah, no, I think we covered everything. I just think, again, as Chris mentioned, we've seen this portfolio weather this sort of COVID storm and actually benefit from some of it. And we've got a lot of those stocks that, were poised to do well in that COVID environment. However, as we start to see the economy reopen, we start to think this portfolio is reacting very well. We've kept an eye on that in terms of the cyclicality and the types of business models that we think are going to do well during the reopening. But we've also, actually over the last 2 months, when we've seen sort of this traditional COVID growth do pretty well, we've actually outperformed in that period just because it hasn't been that monolithic trade. And so we're starting to see that, bear fruit, and we're really excited to see that. And so again, we're really, happy with how this portfolio has performed over the last couple of years, and we're continuing to see it start to do a lot better now in the most recent periods. So with that, I'll leave it, and hopefully, next time when we chat with you guys, we'll be there in person.
Yep. Definitely looking forward to seeing everybody in person. If there are any follow-up questions, definitely feel free to reach out to me directly, and I'll be sure to get those answered.
Kevin, Chris, thank you very much for your time today. We appreciate it.
Thank you.
Okay.
Thank you. Bye now.
Bye-bye.
Stay safe.
Okay, next on the agenda is the Twin Capital Manager. I saw Jeff Gerber was teed up earlier, so Jeff, you have the floor, sir.
Hi there, good morning everybody. Sam Gerber from Twin Capital, as well as you noted, Jeff Gerber, Twin's founder, president, and CIO is with me as well. William, if you don't mind, I might try to share my screen just to control the slides as we might be jumping around a bit, if that's okay?
Yeah, that's great. Go ahead. I'll stop sharing mine if I can get my mouse to cooperate. Well, you got it.
All right, great. I'll start things off, in terms of a very brief agenda in terms of what we'll cover. I'll go through a brief update on the firm and a little refresher of our investment process. And then I'll hand it over to Jeff to talk about the portfolio performance, how it's currently positioned, and a little bit of a market update and outlook. Before I get started, I just want to say, we appreciate to the committee and staff and Brendan for having us in this morning. In particular, also having the ability to participate virtually. We wish we could have come down there. I'm sure it's an exciting time to be down in Gainesville with the start of football season, and good luck to the Gators this year. So in terms of that update on the firm, we ended the month of July with $1.1 billion in assets under management. We have just under $740 million in assets under management in the prime strategy, which is what the city of Gainesville is invested in. In addition to AUM, we have over $180 million in assets under advice, with $175 million of that being in the prime strategy. So in aggregate, in terms of assets that are essentially in the strategies that we manage, whether that be in AUM, where we have discretion and trade the account, like your portfolio, or for some of our clients, particularly in the wealth management channel, where it's model delivery. In total, there's over $900 million in assets in the prime strategy, and as a firm overall, we have over $1.3 billion in assets. Just to note, in terms of the growth that we've seen this year in terms of assets, largely been driven by some of the growth that we've had in the wealth management channel, in particular with our tax managed strategy. We've seen some nice growth with that. And so as we passed our 31st year, the firm has continued to evolve and grown, and we're pleased with that. So unless there's any, I don't have any other updates in terms of the firm. All else is ho-hum on our end. So unless there's any questions, I'll move forward.
Please do, go ahead.
So just a brief reminder of our process, of our unique process, which is the combination of a bottoms-up quantitative model that we've developed over 30 plus years and developed in-house and continually researched. Which is made up of a multi-fact model of 10 individual components across valuation, growth, and quality. Essentially, we're looking for stocks that have the combination of attractive valuation, improving growth metrics, and high-quality metrics. We use that as kind of the key input in terms of wanting to own stocks that rank higher in the model versus ones that don't, ones that we think stocks that will outperform relative to the market. But really, that's just part of our process. We're going to build the portfolios using our proprietary fundamental tilt, which is more of this top-down piece, or as Jeff likes to refer to, the kind of gestalt perspective of the portfolio. And kind of the first component of that is we're really going to focus on managing the risk of the portfolio. As investors, we're all focused on sources of return, but really what we think Twin differentiates is focusing on that risk, making sure that we are going to get compensated for that risk in terms of return, and making sure that the risk that we're taking is efficient. And then the second piece of that is, which we'll be talking about a little bit today in terms of how the portfolio is positioned with respect to capturing those market style themes and trends. For instance, value and growth in terms of capitalization and other type of risk measures. The how we manage the portfolio in terms of getting this diversified portfolio is using the combination of this quantitative model and then building the portfolio, understanding where our bets are going to be relative to the benchmark and making sure we're very smart about where the portfolio is tilted. So with that, I will turn it over to Jeff.
Thanks, Sam. And as Sam said, it's really good. I know that we wish we could be there with you. As some of you may remember, I even have a condo down in South Florida, so I wish I could be there with you, but we do appreciate this opportunity. So just to update you on your portfolio, remember that you're in the prime portfolio, and the prime portfolio, as compared to what Brown does, we're a more diversified. We're not a concentrated portfolio. We're giving you a diversified portfolio that's more core-like. We're trying to beat the Russell 1000 index, not the growth side of the index. So we're worried about both growth stocks and we're worried about value stocks. And as Sam mentioned, our model includes elements of value and growth and quality. I mean, ideally, you'd like to buy stock that's cheaper than its peers, that has better growth prospects and good quality measured in a number of dimensions. And so that's why we have 10 multi-factors or 10 variables or 10 components of our model. But basically, what we're looking to do is build a portfolio that is going to look, feel, and in a sense smell like the Russell 1000, but we're not going to hold all 1,000 names. We're going to hold, less than 20% of those names, and we're not going to have a high degree of turnover. We've averaged, as you can see, 25% a year, and we're going to have a beta that's right spot on with the market. So this strategy that you're in now, we're into our 18th year now, and we're very, very appreciative to have you as a client. Your portfolio, just to kind of give you a view, we're going to give you two perspectives on your portfolio. One is in total, and the second is to talk about the fortuitous timing of your pension obligation bond investment. But overall, we started very fortunately a little over 3 years ago with you for $33 million investment. In 18, 19, and 20, there was $5 million roughly taken out. You put $5 million back in 2020. If you look at your total inflows in total, from the pension obligation, it was 20 million. So basically, as you can see, we've made in your portfolio at the end of July, it was worth 71.2. To give you a more current update, as of 8/24, your portfolio was worth $72.9 million. So you've made now just under $20 million of growth in this 3-year period. We generated a return, as you can see, both gross and net. You'll remember that we do provide a very good fee arrangement for the city of Gainesville. John, your chair has asked about that in the past. We do offer a fee arrangement. Unless we're outperforming the market, we don't get paid a fee. And we generated, as you can see, roughly a 17% growth and net of fee return. It's been hard, as the previous speaker in the last 3 years, to outperform the market, but as you can see, we've taken less risk than the market. We've given you a portfolio that's less volatile than the market. And specifically, talking about your point of, your pension obligation bond, if we go to the next page, you can see that kudos to the committee. I remember meeting with the committee. You met with all the managers last October, end of October, to talk about how do you invest this pension obligation bond. We talked about, I believe others talked about the idea of doing it in a few tranches, which you did do. You did it in 3 tranches in November, December, and January. Of those 3 months, the only negative month where the market, the S&P was down, or the market was down, was in January. But again, excellent timing, because for what it's worth, the 6 months subsequent to that, February through July, in fact, for now, February through August, the market has been up. And so you've generated a very, very strong return. You generated almost a 37% net of fee return, which matches the market over the 9-month period. And year to date, as you can see, as the prior manager talked about, things are more normal this year. It's not like the market last year. The S&P 500 is up 18.4%, yet 200 of the 500 stocks actually were negative last year. And only a little more than 1 out of the 4 stocks in the market outperformed the 18.4% last year. So the market was very concentrated, because it was concentrated, obviously it was tougher to beat last year or the last couple of years. This year, there's been a broadening out of the market. The participation has been broader. You may remember I pointed out to you that for the 5 years ending 2020, there's only 2 out of 11 sectors that beat the market. That would be technology and consumer discretionary. And if you didn't include Amazon and consumer discretionary, it'd only be 1 out of 11 sectors. So the market was very narrow prior. In 2021, other than maybe in June, the market has been much broader. And so you can see you're outperforming by a little under 1% year to date, gross and net of fees. and the market's up 18.4 and you're up 19.2 through mid-August. So kudos on the timing and getting that pension obligation bond invested and getting a significant return on that money since you invested it. The overall, that's just an update on your account. For the strategy itself, just to remind you, our long-term track record, this is through July. The strategy has produced a return in excess of the market with a little bit less risk than the market. It's produced an information ratio that's almost 0.6. That's a very strong information ratio. That's the ratio of value added, which is over 1%, to tracking error, which is just about 2%. As Sam mentioned before, our goal is to beat the market, and our goal is to beat the market consistently through time. We go for singles, we go for doubles, we don't go for the home runs. You have that in your growth managers, you have that in other places in your portfolio. We're trying to give you the market plus some value added or some alpha. In this case, historically, Prime's generated, as you can see, 1.1%. If we go ahead 2 pages to page 13 for those who are following in the hard copy, you just saw from Brown, you saw a 1-year and a 5-year hit ratio. We're showing you here a 3-year rolling hit ratio. So you can see that on a 3-year basis, we've outperformed the market 81% of all 3-year or 12-quarter rolling periods. And similar to Brown Advisory, if you drew a line, in our case, we're, again, tighter risk, but if you see anywhere where the market has been up 5% or less on a 3-year basis, we've significantly outperformed. And to be fair, even in many 3-year periods where the market's up 10 to 15%, we've significantly outperformed, even when the market's up 20 or 25, but not in all periods. Obviously, in very, very difficult markets where the market is up 15 or 20, sometimes if that market is being led by only a few stocks, it's going to be harder for a diversified strategy to outperform, but our goal is to keep pace. So if you notice, even when we lose, we're relatively close to that 45-degree line. So, and the other thing to remember about our performance, just like this is on a 3-year basis, showing you that we do, that our value added always comes on the downside. That's even true on a monthly basis. So even on a monthly basis, if you look at all months since we've been managing the strategy, you take all months and you say, give me the biggest up months, the markets where the months where the market's up 2% or more. Well, on average, we outperform a little. Give me the months where the market's kind of sideways, up or down a couple percent. We outperform by a little more than average. Where did we outperform the most on average? It's when the market is down. And of course, we haven't had many of those in the last couple of years, other than say March and February, end of March and February of last year. There hasn't really been too many opportunities, but that's where Twin adds its value. When you can win more often than not, and you can beat the market on an 81% basis on a 3-year basis, and the market itself has been difficult, you get the next page. So the next page shows you on a peer universe relative to other peers. There's a lot of data on this, and there's some charts. So let's first look at the right side of the chart. The light blue bar is a 3-year bar. So 90% of all rolling 3-year periods since the inception of Prime, we've outperformed the median manager. We've outperformed our peers, or the median manager 90% of the time. You could also see that on a 5-year basis, it's 97% of the time we are beating our peer managers. And in fact, we've never been a low 4th quartile manager. That's never been the case on a 1, 3, or 5-year basis. And it's still the case that 3 out of every 4 1-year periods we're beating our median manager, or the median manager, or the medium large cap core manager. So our performance is certainly consistent, both relative to the market and also relative to peers. To kind of go through quickly a market review, unless there are any questions, so I'll take a breath and ask if there are any questions on the portfolio, performance, and then maybe spend a few minutes on kind of our outlook for the market.
John, just one technical question. You mentioned in 2020, basically 200 of the 500 stocks in the S&P 500 were negative. I'm just curious, year-to-date through the end of June, I'm just curious, do you have a similar metric for 2021?
Yeah, so in 2021, John, just to put it in perspective, you're running at under 50%, but it's probably in the low to mid 40s. And so roughly less than half the stocks are outperforming, but that's still a far better number than the 25 or 28% for last year. It would have been better, John, if you asked me the question on May 31st, the answer would have been closer to 50%.
Okay.
But in the month of June, had the least amount of participation, the least amount of outperforming stocks in June in a 41-year period for the market. So in June, it was kind of the snapback where growth destroyed value, large caps beat small caps and mid caps, and it was very few stocks leaving the market. So overall, the year is better, but I would say to you, John, I wish it was above 50% rather than below. And you can see that in the last 12 months, you've just come up to close to 50%. Just come up to it. And so we actually have a chart that will show that to you exactly on a 12-month basis, not a year-to-date basis, but on a 12-month basis, you can see breadth has been rising.
Thank you.
Hey,
Sure,
John,
and we'll get you the exact number through July year-to-date after this call, John. We'll send that to you.
hey, Jeff, how much of the returns are in dividends?
Oh, so basically, if we go to just page 19 for a second, Sam, if you go to page 19, you can see that right now, because the market is so high, dividend yield is low. So the dividend yield for your portfolio is 1.33%, just above the market. I would tell you that historically, if you ask, what kind of return do we typically get from dividends? Historically, the dividend yield for the market has been closer to 2%. There are times where it's above 2, there are times where it's below 2, like it is now. But on average, it's about 2%. So I would tell you that, if our prime strategy has generated in the last 5 years, as you saw, last 3 years, your return has been 17%. About 2% of that is dividends, 15% of it is appreciation.
Okay.
So thank you for that question. So maybe just to kind of talk about, to maybe while on this page, and then we'll just go back. Your portfolio, the other point about your portfolio, so your yield is like the market. The beta on that bottom portion of the right side, you're right at the market. The sectors on the right side, you're right at the market. We're not looking to take sector bets. What we're looking to do is pick the best stocks within sectors and overweight those and underweight or not hold the stocks that we think are the worst performing sectors. Where are the tilts that Sam talked about? Well, that's on the left side of the page. You could see that relative to the largest 100 stocks in the Russell 1000, they represent now 62% of the market, 61.7, and we're a little over 61, so we're almost neutral to those. We're a little bit underweighted to the next largest, and where there's a little bit of a tilt, you could see is kind of in the mid-cap range. The deciles 4, which would be, call it stocks 400 down to 900. So that's where we're a little bit overweighted in that mid-cap section. You can see we do have still a little bit of a tilt towards value. Value did very, very well end of last year and through May of this year. The last couple of months, growth has come back, particularly starting in June, but we still think that value over the next 3 years is the right place to be in the market. And the other thing interesting about our tilts is that when we talked to you last time at the end of December, we talked about the fact that what we were doing is raising our weight on dynamic stocks. Because starting in the fourth quarter of last year, we recognized that we needed to have participation in the recovery. And with, of course, the vaccine coming out on November 6th, we knew that it would be the very volatile stocks. So starting really at the end of September of last year, we started raising our weight towards dynamic stocks and lowering our weight to defensive stocks. But recently, we said, well, wait a minute, we think the market has really run up very high, it's really priced to perfection, so maybe we should reduce our overweight to dynamic stocks. And for those, just to remind you, dynamic stocks are stocks that are more dynamic, meaning they're more volatile in earnings and in price. Their price moves around more, their earnings are more variable. So you can think of energy stocks or financial stocks as being more dynamic, and you could think of, staples perhaps as being more defensive. But again, we're not taking a big bet, but you can see that, if you look at the end of September if you look at the end of September of last year, you can see we were defensive. By the end of last year, we became dynamic. We went below the line in the gray bars, and we continued to go down through March, and then started reducing that down, and you can see now we're even under 1%. So you can kind of get a feel for how we've tried to position the portfolio. Like back in 19, we were much more neutral. Now we're a little bit more value and a little bit more mid-cap oriented. And in between there, we became more dynamic and now less dynamic. So that's kind of gives you a flavor. And to put it in perspective, just to think about, the markets, maybe just to go back for a second half outlook on page 18, Sam, just to talk about what we see in the market. So for what it's worth, at the end of June, last year closed at an all-time high for the S&P. June closed at an all-time high for the S&P. Yesterday was an all-time high for the S&P. In fact, the S&P has hit 51 new highs so far this year on 163 trading days. 31% of all days this year, the S&P has poked in with a new all-time peak. I will tell you that the first half of the year, as you know, was phenomenal. Big double-digit return. We went back and asked, well, how often does it happen that the S&P in the first 6 months of the year is up double digits? Well, believe it or not, it happens 3 out of every 8 calendar years that the market in the first half is up double digits as it was this year. We then said, well, what happens in the latter half of those 22 years? And it turns out that in 18 of them, or 86% of the time, the average second half return was still positive and averaged 7.3%, so far less than the first half of the year, but still positive. Certainly, July has been positive. August has so far to date been positive. I'll just have to say that for what it's worth, here are little probabilities. We've now had 6 consecutive months of positive S&P return. Now, remember, 2017, every month was positive. That was the rarity. That's never happened in any calendar year back to the 1900s. But, so it does happen that you have streaks of 11, 12, 13. We've had one 14-month streak back in 17 and early 18. But you now have had the S&P advance 6 months in a row. With August, it will be 7 months in a row. 7 months in a row only happens 4.7% of all the time. And if it continues to be positive in September, then that's going to be 8 consecutive months, which has a probability or likelihood of 2.5%. So you're not talking about a high degree of probability. Add to that the fact that September is the only month in the calendar year since the 1950s that the S&P has a negative average return for that month. Given that, we think that if the market does end up here in August, where it's certainly leaning towards, if that's the case, that the likelihood of up September is fairly small. So we do think the second half of the year is still going to be positive, but just not as positive as the first half. So just to temper your thoughts and to think about the fact that there may be a little bit of a correction or pullback. The other thing about a correction or pullback is keep in mind that historically the market is down, historically the average drawdown every year is 14%. The only drop we've had this year is 4%. In fact, historically, the S&P 500 has 3 pullbacks a year on average of 5% or more. 3 on average. The last time we've had a pullback of 5% or more was October of 2020. Right about when we met was the last time there was a pullback. So, of that magnitude. So I would have to say we should expect some more volatility here in the latter half of the year, particularly maybe in September. It's interesting. I think the real key, and we said it we said it actually on the page before in terms of July. That I think the key to really think about is the 10-year. I think that the 10-year yield has really been an important indicator. It dropped from 144 at the end of June to 123 at the end of July. Now in August through today, it's back up to 134, 135, 136. So it's back up. It's not at the 144 level. It's certainly not at the 174 level we saw at the end of March. Remembering that as interest rates go up, that tends to favor the financial stocks. And as interest rates go down, that tends to favor the growth stocks. And so it'll be very interesting to see what Jerome Powell, Federal Reserve Chair Powell, says tomorrow at Jackson Hole when he gives his speech. As you know, there is strong discussion of tapering beginning even as early as September. And we know that the last time the Fed did have a taper, we called it the taper tantrum, the market will likely have a correction or a pullback as a result of that potential outcome. It's also the case that the Delta variant, as we know, has become much more rampant. Earlier this month, as Brandon and John know, we were hoping to be there in person with you, but as things continue with the Delta variant, trying to get it under control, that's an uncertainty. And the only other thing I'll say about earnings in terms of pricing to perfection, the third bullet here is now true for the quarter. The quarter is now over. This was the highest percentage of earnings surprise ever in FactSet, since FactSet has been measuring it. So this second quarter's earnings, which were announced in July and August, 87, that's actually, it turns out to be 87% of all companies, of all S&P companies, reported quarter two earnings that were higher than the consensus estimates. That's never happened before. So the market continuing its run makes sense because companies are continuing to earn money. And at some point, any disappointment could be coming out. But the other interesting thing I'll just point out is healthcare was the best performing sector in July. And so perhaps after the market being led by tech, the market being led by consumer discretionary, perhaps healthcare, other sectors, as we said, are now participating. As you can see here for a year to date, it's not like healthcare has outperformed the market, it's actually underperformed the market through mid-year. But in July, healthcare is starting to come on strong. So for what that's worth, those are kind of the trends we see happening in the market. And the last thing I'll get to is really page 23, because it relates to, John, your question about breadth. You asked about year-to-date, John, and we will get back to you later with the actual year-to-date breadth year-to-date. But just to give you a flavor for the S&P, this is on a 12-month basis in red. So what you're looking at in red is for that 12 months, what percentage of the 500 stocks beat the market, what percentage did not beat the market. Notice that only recently did you, as I say, get above, get around that 50+% level. Only recently. In blue, we overlay the investment, median managers, value added relative to the Russell 1000 as an overlay. You'll remember when we showed you these red bars before, you've seen the red bars, you've not seen the blue overlay. When you've seen the red bars, we've always argued, when I teach executive education, I teach investment policy and manager selection and evaluation at Wharton Executive Education, I always point out that I've successfully been managing institutional portfolios for almost 40 years now, adding value, and in another 35 years to 40 years, we'll be able to tell whether it's statistically significant. Because the reality is that there's so much noise in returns. So the only way to really say, what is the probability that a manager is going to outperform is to simply say, how many stocks are outperforming the market. The greater the percentage of stocks beating the market, the better the chance the manager has, even if the manager just threw darts, of beating the market. And what you see here is a very high degree of correlation between the median manager's excess return, which, to be fair, since 2016 has been negative, and frankly, to be fair, since 2012 or 13 has basically been negative. Only one little blip did you see at the end of 16. So basically, the median managers underperformed the last 5-6 years on a trailing 12-month basis. Why? Well, because in the last 5-6 years, breadth has been very, very low, well below 50%, and in fact, only once was it ever lower. In September 20, it was at the lowest level it was back into the late 90s. So that's what happens when the red lines are going down, the market's getting more concentrated. When the red lines are going up, or the red bars are going up, it means that obviously more stocks are beating the market, more stocks are participating. So the good news is that putting aside the June kind of pullback, the market has been getting broader. You're seeing that in outperformance from both Twin by roughly almost 1% year to date, 80 basis points. You saw it from Brown. I imagine you're starting to see it from your other active managers as well, because as the market participation grows, it becomes easier for managers to beat the market. So with that said,
Jeff, just to interject for 1 second, to answer your question, John, through yesterday, that the breadth number year to date for names outperforming the S&P is just over 49%, 49.3%. And for reference, at the end of July, it was just over 50%. So it's been, over the last couple of weeks, year to date, it's been hovering at that, just at that 50% number.
Thank you.
thank you, Sam. We don't even have to wait till later. So, so thank you. We're happy, Sam and I are happy to take any questions from the committee, from the pension review committee, from Brandon, staff, etc.
Any additional questions? You got one here?
I have one. You mentioned earlier your kind of rotation out of financials, obviously, and then to follow that up, you mentioned obviously interest rates and how financials will perform well in rising rates. I guess what is your overall stance on that, or what are you guys kind of macro thinking about, rates and financials in the portfolio?
Sure, no, absolutely. That's a great question. So let me just, if I could clarify, because we are sector neutral. So just to remind you, if you go back and look at our sector weights, I believe it's on page, yeah, thank you, Sam, on page 19. So if you look at our sector weights, you can see that basically we're right in line with the market. We're just a little bit overweighted in financials. We were a little bit more overweighted in financials, maybe 20 or 30 basis points earlier in the year. That's when rates were rising. When in the first quarter was a great quarter for financials, a great quarter for energy stocks for that matter too. But financials had a great first quarter. Why? Because at the beginning of the year, the 10-year was at basically 98 basis points. To start the year at 1%, call it, it went up to 174 by March. So in a 3-month period, it went from 1% to 174. That was a great period for financials. We were a little more overweighted to them. In the second quarter, as we pointed out, those rates started to come back, and you could see we're a little bit overweighted to financial, but basically in line with the market. And I would tell you, I do think that rates will, right now, we're seeing rates, they come back up, we're at 136. I think we're going to be in a 150, I would say 130 to 170 range, basically. I think that that's really the range, so I think we're still at the low end of the range. Certainly when Powell speaks tomorrow, if there's any indication that there will be tapering, and just to remind you, tapering means not that they're going to raise interest rates, it just means that they're not going to accommodate, keep flowing money, as much money into the economy. There'll still be money flowing in, but just not as much. And that will likely have an impact and continue to raise rates. One could argue that rates have gone up from 123 to 135, and actually they were as low as 114 a week or so ago. They've gone up 20 plus basis points, I think in somewhat anticipation that the Fed will start tapering. So I do think that financials, healthcare are probably the better sectors going forward, but not that we're going to take huge sector bets, because we don't want to take huge sector bets, because right now you can look at the bottom line on this page, the tracking error, which is the deviation from our portfolio to the market, is just about 1.2%. So we're not taking a big deviation from the market. We're not looking to take big sector bets. We're not looking, when I was talking about dynamic before, I was talking about dynamic stocks tend to be financial, they tend to be, but there are also tech stocks that are dynamic. There are healthcare stocks that are dynamic, can have more variability in earnings. So when we went to go look for dynamic exposure, we didn't just do it in one or two sectors. So I apologize if I gave you that impression.
Okay,
But I hope that clarifies.
Absolutely.
Both that as well as our outlook.
Jeff, I just had a question, talking about the tracking error and your allocations, you obviously mentioned you're not trying to take big sector bets. And obviously you've got a reasonable range for the tracking error, but if you felt very convicted about the market one way or another, how far would you go with your tracking error? Like, could it extend out to 3, 4, 5%, or is there a limit to how far you'll go?
Well, that's a great question, Brandon. I mean, from a limit standpoint, we would not want to go, once you get to the 3 to 4% range, we would be concerned about that. But we certainly could go from 1 to 1.5, 1.5 to 2, if we were really confident. And to answer your next question, which is, well, when would you be more confident? We'd be a lot more confident when the market participation that we've started to see this year, I mean, to John's question, still, we're only at 49% year to date. So when we're running at 55, 60% on a more consistent basis, that will be a much better time for us to kind of increase our tracking error or predicted risk, if that makes sense. Because the odds of us outperforming are greater, and it's also a question of how our model's performing. Our model has performed much better this year than it has in the past because fundamentals matter more. So to the extent that fundamentals matter more, to the extent that there's more participation, we would be very willing to take on more risk. That said, if the risk models underestimate the reality, a 1% tracking error could still produce a 2.5% value added. I mean, we're already sitting year to date with almost a 1% value added with a 1% tracking error. So you can't obviously annualize that 80 or 100 basis points for the rest of the year, but you get the idea that there's, it's a prediction, it's not an exact.
Thank you.
Does that help?
It does, thank you.
Sure. No, thank you, Brandon. Any other questions? We're happy to take.
Nope. I don't see any more questions. So I think we're about ready to wrap things up. Do you have any final comments, Jeff or Sam?
Nope, we just wanted to say thank you again. We appreciate the relationship now for over 3 years and look forward to seeing everybody hopefully in person next time.
Great, as do we. Thank you very much.
Thank you. Thank you all. Stay healthy and stay safe.
Thank you.
Bye-bye.
Okay.
Can I get some of whatever Sam is on, or Jeff is on?
It's like a walking encyclopedia.
What does that guy have for breakfast? I need a nap after
Well, next,
God, he's good.
Brendan, we have, you're up next. I see we've got some older reports, things how we didn't meet last month, but I would suggest as usual, let's get to the more current.
Yes.
What happened historically is less of interest at this point.
So we do, obviously have a bunch of stuff, a couple different, market commentaries. I won't even go through that other than to just say, really the fundamentals continue in strong fashion. The unemployment numbers continue to improve. Obviously, the Delta variant is sort of a wild card in the mix, but at least so far, the economy seems to be kind of powering through. Obviously, inflation is the other one that has come on board. We certainly, Jeff talked about that at length, helping certain sectors. So as long as it doesn't become such an issue where you go from, 2-3% inflation to 4, 5, 6, that really becomes a problem. But a moderate level of inflation, I think, is reasonable and kind of what we would expect. Once you get through some of this kind of transitory, I think you've got some one-off supply chain constrained issues that we're certainly going through. But as a general backdrop, the economy, that just the numbers underneath still continue to look very good. So we have the big June 30th book, but again, since we have the July, I went ahead and let's just talk about the July, which is the thin book you have in front of you. On page 2, which is kind of the first page, just a review of the assets. We were down ever so slightly in July from the month of June. So you'll see June on the right, bottom line $729 million. We finished the month of July, $728.9 million, so again, down just fractionally. But to put this in perspective for you, at the beginning of the fiscal year, excuse me, I had that as 7-1. On 7-1 of last year, the plan had $408 million. Over that time, obviously, we got the pension obligation bond proceeds. You've had income along the way, dividends and income from the fixed income portfolio, an appreciation of $165 million in dollars to ultimately end up where we are today at roughly that 729. So just kind of wanted to give you some extra numbers that weren't on that page. If you flip over to page 4, I mentioned the assets being down slightly. So if you look in the upper left-hand corner, we were actually down for the month of July, 8 basis points, versus the benchmark, which was positive 51. Most important number on that page is about the 5th column over, the FYTD, fiscal year to date. And again, this is net of fees, 26.98% versus the benchmark of 24.49. So net of fees outperforming by 2.5%. And again, as of today, just sort of a back of the envelope, we're probably up another 1.5% on that number. So certainly, knock on wood, we're obviously not to September 30th yet, and I hope what Jeff had to say doesn't hold true about September being a challenged month. But certainly we are in a fantastic position in both absolute as well as relative performance. And again, you can see the longer term, a little bit behind on the 3-year, but then when you get out to the longer periods, 5, 7, 10, and over the longest period back to 1994, net of fees outperforming by 90 basis points. So after you've paid your managers, and your weighted average fee is 53 basis points for this portfolio. So after you paid that 53 basis points, you still had a net 90 above the benchmark over the long haul. Just touch on a few of the managers quickly, because again, it was somewhat of a reversal. Twin, who you just heard from, had a very good month, which is of course the quarter to date. And if you look at the calendar year to date, they're outperforming 17.75 versus the 17.3. Barrow Hanley.
Can I interrupt you real quick?
Sure,
there?
go ahead.
I hate to do it, but while we're on that topic, we just heard from them. You mentioned a couple of times the portfolio is outperformed, but as I look at these numbers and I was looking at these other numbers, I don't see outperformance on a 1-year, 3-year, or even since inception time frame. So I'm just a little confused at where his numbers were coming from.
He's studying historically, if you look at a 3-year rolling, 81% of the time they've outperformed.
Okay.
But not recently.
So when do they charge, he mentioned their fee. When do they charge their fee and how do they assess their outperformance versus?
I believe it's on a rolling 1-year basis.
Okay.
So when they get there, I'll have to go back and double check just to make sure, but they have to be outperforming. So even still, like on the 1-year basis, they are still behind.
Correct.
So you're not even subject to a fee at that point.
Okay.
You really, because really since inception, they haven't.
Well, that's what I'm wondering. I
So-
mean, you can't continue to manage money for free forever, so, I mean, I wouldn't think that's a good business model.
Correct. Well, here's the flip side of this too, what I would say. And this is kind of a discussion we had roughly 6 or 9 months ago. Yes, it's great to get portfolio management for free, but if you can get the index for 4,
Sure.
I would rather have the index minus 4
Correct.
than be 100 basis points behind because you're not paying anything on it.
100%.
But again, I think it kind of gets back to the whole, the breadth discussion, the narrowness, that certainly has been an issue, and it's particularly, focused in that kind of that 3-year number. But what we've seen, the trend more recently has been better.
Okay.
Not only with this manager, but you'll see it with Brown and some of the other ones that have struggled.
Suggestion to fire somebody off of near-term performance by any means, but I was just curious.
But to that point, like if we don't see the improvement continue, then it really gets to that point. Well, yes, great, we're getting it for free, so to speak, but you're getting a net number that's still lower than the benchmark to make that adjustment.
I think I brought this up before, though, Rick, is in 3 years, if you take 50 basis points off, you're still 2% behind. How much above the index is he going to have to get in the next year or two to get that back?
It'll take a good bit. There is no doubt.
That's 2/3 of the pension obligation bond right there. That's one way I look at it. That's interesting.
For one manager, not for the entire rec bond
Just for this
proceeds.
guy.
Unfortunately, I mean, I look at past underperformance as sort of a sunk cost. I mean, it's unfortunate, and you'd like to see them get that back, but I'm more concerned about future performance than past performance, so.
Yeah, but there's no guarantee of future, so
Right.
all we have to look at is what he's done. And, absolutely, we may not get it back, but if we're gonna continue to, get free portfolio management that's less than the benchmark, then we're doing ourselves no good,
Right. My bigger concern is, do we want to continue to have sort of a Russell 1000 index type manager, whether it be an enhanced index manager or not, versus an actual large cap growth manager? Because, even with Brown's, somewhat underperformance there, you can see their returns compared for everything except maybe the fiscal year to date. You go back and look at a 3-year return, and they're outperforming Twin by 1,000 basis points. And so to me, I mean, I'm concerned about managers, but I'm more concerned about that actual asset allocation between a core large cap and a growth large cap. But I'm sorry, Brandon, go ahead.
No, to your point again, but I want to spend a lot of time on it, but I was less than enthusiastic about indexing a number of years ago. We had a CFO from GRU who felt very compelled. Since they have 60% of the employees in the plan, we basically acquiesced. And it wasn't a bad decision. From a professional standpoint, I look at my biases. I wasn't for it. Having said that, I think it's valid. One, I think Twins kind of quality overlay makes sense. Certainly, it's been a very tough environment for active managers because of the high concentration of a few stocks. If you didn't have a couple of big winners, you weren't getting much excess returns over the last 3 to 5 years.
Absolutely.
Having said that, we're going to have an ongoing debate, probably for the next 20 years, of whether active or passive is the way to go. My bias, which I think I've shared, is I like active thinking people that are looking at businesses as actual functioning businesses and evaluating them appropriately. I think that's the appropriate rational way to proceed. Having said that, we're going to have trustees, commissioners, participants question, should we have passive or active? I think it's useful to have almost a benchmark of a passive but quality controlled index like Twin that we kind of look from year to year. And to your point, Brown looks like a genius at 1,000 basis point outperformance over a time frame, where a couple of years ago we all wanted to basically crucify him and fire him because of the same. So I think they play a useful and capable role in our overall portfolio, and I think it's also good to have an actual comparison between active and passive. And certainly it's not such a large allocation that if active really outperforms, are we really getting hurt? The answer is no. And again, the fact that if they don't beat their index, they don't get paid over some time frame, I think that's fair. So anyways, that's my personal and professional biases and opinion on that question. So anyways.
So again, jumping back in, Barra Hanley, who your large value manager, down 71 versus 80. So again, a little bit of a reversal. They had been doing incredibly well so far, and you can see that whether it be the calendar year to date, fiscal year, and so on, or the last 12 months, 45 versus 39. Brown, again, you just heard from, 4.5 versus 3.3 for the month. And for the last 6 months, 22 versus 17. So again, really starting to see that performance, at least turnaround. I know it's only 6 months, but certainly headed in the right direction. Pzena was down 2.5 versus 3.6. For the last 1 year, again, outperforming 64 versus 63. And again, that being the best returning part of the portfolio. DGI, 2.5 versus about 1%. And for the 1 year period, 43 versus 34. So again, another one that's seen a very strong performance over the last 12 months in particular. When you get to the 3 and 5, they sort of have a little speed bump there in the terms of the performance. But again, when you get longer term, or certainly since inception, incredible annualized outperformance. And again, I suspect that with the 1 year being 9% ahead, within another quarter or two, that 3-year will probably be back to neutral, because of the endpoint sensitivity when you add good performance in. The other area, of course, is in international. Both of the managers have struggled just recently. 69 basis points to the downside for Silchester versus -24 for the benchmark. Although again, for the fiscal year to date, 29 versus 31, again, a bit behind. Bailey Gifford, down 4% versus a positive 1.7, so big kind of miss in the month. And certainly you can see that recent performance has really been difficult. Going out to 9 months, they're about 9% behind, and for the calendar year to date, about 9.5% behind. Again, longer term, last year, 2020, they were by far your best performing manager. They doubled the benchmark and looked fantastic. I think what you've seen certainly is the effects in China. They've got Tencent and a number of those securities that have been hit. And coincidentally, they're going to be here, well, on the video next month, both of your international managers. So I think that'll be very helpful given some of these discussions about China, the regulatory environment, because they're the manager that's most present in that market. And so I think they can help have some of that discussion for you to kind of explain what's going on with a little bit more depth. And then again, Loomis, the fixed income, it's a very small allocation, essentially in line with the index, but outperforming over the trailing periods, although there's not a whole lot of return there. Certainly year to date, it's actually negative. And then Principal, the real estate portfolio, again, is underweight after harvesting some of that money at the beginning of the pandemic last year. And then certainly with the pension obligation bonds and not adding any money in, it further shrank as a part of the overall allocation. But it has actually performed pretty well, on the 9-month or the fiscal year-to-date basis, 8.5% versus about 6.8 for the benchmark. So really, again, very strong absolute performance. As we're getting close to the end of August, knock on wood, this month looks, very strong again. So the plan overall is performing incredibly well. Certainly some relative bumps here and there, but again, one other thing, I think it gets back to sort of that index discussion. If you put yourself in a relative framework, other cities around Florida, other pension plans, they don't want to take as much, relative or index tracking error risk. There's more of that discussion. Should we have more index exposure, lower the fees? But that may be with a 65% equity allocation. You guys have a significantly larger equity allocation. So taking then that full beta market level risk with an index portfolio or otherwise, with that equity allocation, there's a little bit of a nuance there. With that larger equity allocation, there's certainly an argument for taking some defensive, posture with those managers. So even with a twin that's a enhanced index, still tries to be a little bit defensive relative to that benchmark. But if you look across the board, whether it be Brown, Pzena, DGI, they tend to be lower vol, a little bit more defensive overall, given your high equity allocation. So I think that risk component is important to consider when you think.
Do you have the risk metrics for each of the portfolios, Wajid?
They are in the big book, which is
I'll
here.
track them down
But yeah, there is a very lengthy report with all of that in there. I'll stop there. Harvey, you have a question or comment?
I was wondering, have you seen the rotation in the values? It's like 6 months ago, we're talking, values going to be the next thing, and it hasn't really happened.
Well, it really happened from November, was it 3rd or 4th? Maybe it was the 6th when the first vaccine was approved, through the end of May. The difference between value and growth was extraordinary. Then June happened. There was a complete reversal. So if you look at, I'll just pull these numbers out, but on the big book, June 30th, for the quarter,
What page are you on there?
page number 7. And I'll use the 1,000 value because we've been talking about the 1,000, most of our exposures in the large cap. So I'm in that second group of charts in the upper right-hand corner of page number 7. For the 3 months, value did 5.2, but growth did 11.9. For the first 60 days of the quarter, value was outperforming growth by 300 basis points or something. all of that happened in June. You get to the end and like, oh, here we are back to a growth market. But it really was this huge snapback. And that's when, again, as they mentioned, the 10-year went from 145 to 115. Now here we are again going, it sort of stabilized in that 1.2 range. Now we're up to 135. So I think as interest rates go, I think you're going to see that really correlate with whether it's value or growth that's leading. And so again, I haven't seen the numbers for the month of August, but I suspect value is doing better again intra-month or this month because rates have stabilized and started to move higher.
It has the last 2 weeks.
Yeah, why is that? I mean, I understand why financials go up when interest rates go up. But why did techs not do well when interest rates go up?
I think it's not that it becomes an anti-tech, it's just
Large cap in general.
large cap in general, but again, it becomes a catalyst for rotation. People are like, okay, rising interest rates, I want to be more defensive, cyclical, and or in financials because they tend to do better, they get better spreads. And so it's just sort of that automatic, okay, let's rotate out. And where do we rotate from? And certainly the low interest rates, I mean, just generally speaking, helps, for non-dividend paying companies and other things like that.
Cost of capital.
Cost of capital, they look more, they look better as rates are stable or falling. As rates are rising, it becomes a little bit more of a headwind. And again,
Some would beg to differ in some certain stocks. Apple, for instance, who has billions of cash. It shouldn't matter if rates go up, and we can all debate that at length. But I mean, generally speaking, the large cap stocks don't have cash like Apple does.
But
not all of them.
But the thing that, what I would say, kind of ignoring the month-to-month nuance, if you just take a step back and say, okay, growth stocks typically trade at, X on earnings, they're well above that. Value stocks typically trade at Y, they're well below that. Now, because interest rates move one way or another, or we get some COVID, variant headlines in the paper, the market's going to move one way or another. It's impossible to know that, but I think just generally speaking, when you look at kind of where the market has been, where valuations are, certainly the pendulum is more likely to be on the value side moving forward than it is on the growth side.
Who's going to be the winner when you throw a couple $1 trillion in the economy?
Depends on what the bill says it's spent on.
Yeah. Let's see. And this is the hard part. We kind of talked about this somewhat when we had the infrastructure conversation because, well, first of all, we've been hearing about infrastructure for 12 years, 10 years, and it really never happened. Now, yes, we're sort of maybe getting a bill now, but then the question is how much actually comes out and when? And if you really dig down in the numbers, it's $500 billion, but it's over 10 years? That's not enough to really make that big a difference. Maybe, you get back to a Barrow Hanley who's owning some of the material businesses, concrete companies, things like that. Well, there'll be some benefits there. But, is there all of a sudden going to be this giant pile of cash that just lands in one sector of the economy that makes it, go up by 50, 60, 100%? Not likely. And so, we would actually expect it's a positive thing, injecting that money into the system ultimately becomes a positive, but it's not enough money or it's spread out over such a long period of time that it's not significant. The tapering, all of the other money that's being added to the system, that's a lot more than the infrastructure.
Oh, yeah.
And so that's kind of more significant. What does that do to interest rates? What does that do? Right. So again,
What's the real consequence, you think, of keeping interest rates where they are, assuming inflation is persistent? And when I took economics, interest rates or long rates were going to be 200 basis points over whatever the inflation expectation was. And you're keeping them so artificially low now. How long can you do that without some kind of significant consequence in the market?
I think that's a relative question because what I mean is it's relative to the rest of the world. If you're keeping your rates low, to your point, if you're keeping them artificially low, while the rest of the world is at 4s and 5s, then I think you get a very different answer than, how long can we keep them low if the rest of the world is at or below us, which is the case. And so I think you can go for a long time as long as that is the relationship. And again, we're not out there seeing dramatic increases in rates across the world. Yeah, certainly generally rates are moving up, but it's not like all of a sudden everybody else is passing us and moving significantly higher. We're not seeing that. And so again, I think it can stay like this for a while. And the Fed has certainly been active. But as long as the rest of the world's rates are still well below ours, there's going to be a natural pressure to keep rates low because foreign money is going to come in and buy our securities. That's a big part of the reason that rates have been held down.
Yeah,
Now again, if all of a sudden,
yeah.
if you can go to Japan, if you can go to Germany, you can go to all these other developed countries and start getting 4s and 5s out of their 10 years, that's a totally different discussion.
Then you have a significant systemic risk to the equity market.
Well, because think about it, all the foreign money parked in the dollar so that they can buy treasuries. All of a sudden, you're selling the treasuries and selling the dollar to take it out and move it elsewhere. Now, all of a sudden, now you have a much bigger thing.
That's a very low probability.
I agree.
That's not
I think it's a
gonna
low probability, but it just gets back, you asked how long can this go?
Yeah,
I think it can go on for quite a while because, again, I don't see the rest of the world all of a sudden shooting way up in terms of rates.
I can't afford to.
Right. So I think it is relatively muted. Now, do rates trend higher just because there actually is inflation? Absolutely. But I don't think that all of a sudden, completely changes the game, where you go from 150 to 5%. Like, we don't see that. We see it trending higher, over a couple of years, maybe getting to 2.5, something like that.
Good question, but no, it's strange times. A lot of stuff I learned in finance and economics.
that's kind of the answer in my own life, I've come up with too. It's weird compared to every place else. But in the end, it does sort of, just seem to be different than the classic economics.
Certainly. Yes, absolutely. Now, William, I think it was maybe later in the agenda. Did you want to touch on the POB?
Yeah.
Or maybe we'll see if there are any other questions and we can get to that later.
Sure.
I'm good. Go ahead. That was next on the agenda.
Okay. So, Brendan had helped us, and provided some partial month manager return numbers. This was something actually that the city manager had requested that we do. He wanted to know how the bond proceeds had performed and contributed to the pension plans. So we came up with this table, and I apologize, it got so wide we had to split it into two pages. But basically what you can see are the managers who received pension obligation bond proceeds. They received them, for the most part, the equity managers in any event received them in 3 tranches on November 5th, December 21st, and January 15th. And you can see the corresponding returns for those time periods. And scroll down. You can see the totals here at the bottom, what the returns were for all of the money invested across all the managers. And then as we come down a little bit further, you see the performance from January going out through June. And so the bottom line is that we invested, $156 million, give or take, over those 3 tranches.
168 up through, is that right?
156. And that money grew to a total of 180 million. So we had almost 25 million in returns and a return of almost 16%. And just because the manager had asked the question, we also included what the return would have been if we put all the money in on November 5th when we allocated that first tranche, and it would be a little bit higher, about a little over 20%. But we 16% is a pretty good number as far as we're concerned. We included a few graphs here. This just sort of shows the timeline of how the money was put to work, and it includes the returns, that were earned as well. So you see how it grew in the 3 steps in November, December, and January where the money was put in. And we had a slightly down month in January, but since January it's been all up. And prior to January it was up as well. This is each manager's cumulative return here, and you can kind of see how the value managers performed pretty well, and then recently they didn't perform quite as well. That's the value twist that we had talked about, that we were seeing, and it's kind of recently it's kind of reversed itself a little bit, but we'll see how that plays out going forward. This is just by asset class, how the performance of the bond proceeds occurred. U.S. equity, was by far the greatest, best performance. International performed okay, and fixed income, we only allocated an initial tranche to that, and not much money at all. So it's had a negative performance with the bond proceeds, but it didn't impact the plan very much. And this chart just shows the value versus growth, U.S. equity. And again, this is just to illustrate that value orientation twist that we saw starting in January and going through May, and then coming down a bit in June. And we'll see, again, a lot depends on what the Fed actions are and where we see interest rates going and that sort of thing. But as Brendan said, we still think that value equities are more undervalued than growth, and so there's potential there for that to continue.
And just to kind of comment very briefly on it, what this shows just the actual performance of the dollars, but what it doesn't highlight is the fact that the value part of the portfolio actually got a larger percentage of the allocation.
Right.
So overall the plan benefited by, call it luck, whatever, but just the fact that the value did better after getting more of the money. That was kind of just sort of following the policy, following the allocation. It certainly worked out so far.
Thank you. That's good. That's interesting. Yeah, it was.
It's a great chart.
If you recall, and I'll be happy to acknowledge when I was, incorrect. That does happen from time to time. But I was definitely much more resistant to putting the money in quickly. And again, the collective wisdom of the committee and staff, we kind of compromised. But clearly, the decision to deploy the money relatively quickly, worked out very well for the plan. And I will be happy to say that I was wrong and wanted to drag it out longer. So at least in hindsight, we made the right decision.
And I don't think anyone expected the markets to perform the way they have.
There were strange times.
There was certainly a lot of potential for volatility, and I think everyone thought there was more downside potential. But, we'll take luck.
Yep. I'll take good luck.
Yeah, exactly.
So.
How did that happen? Maybe do this offline, but how did you pick the time? In effect, this is the plan going on margin.
Yeah.
How did you pick the time and the amount?
A lot of debate within the committee, yeah.
Well, do you mean with the tranches or the fact that the POB was done in the first place?
If the POB was done in the first place.
So
we can talk about
yeah.
that separately.
That happened outside the purview of this committee.
Yeah.
It had to do with the interest rates at the time. We'd seen really low rates, when the pandemic hit. You'd seen rates fall in 2019, And then in 2020, when the pandemic hit, you saw them fall again. And, you know, the city manager that we have, he had done pension obligation bonds in some other cities that he had been in. And he came to the city of Gainesville, I want to say toward the middle or end of 2019. And he saw that our plans weren't fully funded, and he saw where we could issue bonds, and it made sense to do that arbitrage. And, you know, there was no guarantee that we were going to earn our assumed rate of return of 7.9%, but we were able to issue bonds at just a few basis points over 3% all-in cost. So if you can issue bonds at 3% and you expect to earn 7.9% over the next, you know, annualized average over the next 20 years or more, it makes sense to do that. Now, I wasn't as convinced about how the markets were going to perform when the bonds were issued at the end of September, but it's worked out pretty well.
Well, we have very short-term performance to look at this point in time, but.
Absolutely,
Yeah.
yeah.
But the thing with the bonds is the nearer term performance matters much more.
Yeah, you get clocked on the first.
Sure, yeah,
first
not
year.
getting whipped right out of the gate is helpful.
Right. So, I mean, we've started out well enough that even if we have some underperforming markets or returns in the plan going forward, this has benefited us enough that it won't have as much of an impact.
I was just with another city that's starting to talk about the POB and just sort of what's the risk reward. And well, you have to think of it. I mean, timing plays a huge component. If you're a city that issued a POB and dropped the money in on February 1st of 2020,
Yeah.
I mean, you're back positive again, but that first 6 and 9 months would have been a very difficult period. So certainly you guys putting it in, it has worked out beautifully.
Yeah, I think some of the hesitancy was the pending election at the time.
Sure.
We got all the money.
Well, and you know, did we know the vaccine was going to be approved? You know, that all that happened at the same time. You got through the election, you got the vaccine approvals, and all of a sudden the market starts to say, hey, we can be more comfortable now. We see more light at the end of the tunnel. So,
All right, well, very good. I appreciate the report. That's very positive for the city and for the participants. That's great. I don't see any public members. Are there any public comment or questions remotely? There's no one here at the conference room.
No, we don't have anyone any public joining us remotely at this meeting.
Okay. Our next meeting date then September the 23rd. Again, we'll be meeting here again unless something dramatic happens. Yes, Harvey?
If you need your CEUs, they're supposed to be having a trustee school in October, but whether or not it's going to be virtual or in person. Right now, it's in person, Sawgrass.
Okay.
If the right things are going, not really sure.
Yeah.
It's going to be virtual, Jeff.
Yeah, okay. Well, we'll see how that plays out. I know I didn't attend any FPA, or any FPPTA conferences last year for obvious reasons. And I'm
I did
sure
a virtual thing.
Yeah.
Right.
So we'll see.
Sure.
Okay. Great. No other items then for discussion? I'll be happy to entertain a motion and a second to adjourn.
So moved.
Got a first? We got a second. Meeting's adjourned.